We found a wealthy trader who made money on Astrazeneca, ticker symbol AZN, today, February 20th. And this is good information because when we follow traders who make money, we usually make money too. So in this video, we will show how we know this trader is profitable and what their current trade is. So without further ado, let's get to the data as usual. We will be analyzing this set of data here at 10:45:52 second mark. You can see there's actually 5 entries here, okay? And the last two over here is actually the same expiration cycle, March 1st, and the same strikes, 63. So we can add these two together. Okay, so 1,445 plus 340, 1,785, which is actually this one right here. Okay, so the other March 1st at the 66 strike, you'll see that this quantity is the same. So the 63 strike calls and the 66 strike calls, 1,785 contracts. Okay, so what is going on here? Well, let's take a look at the March 1st, and then we'll take a look at the March 15s, these 66 strike calls and 70 strike calls. Okay, so for the March 1st, when we take a deeper look at the chain here, for March 1st, at the 63 strike calls and the 66 strike calls, you can see here that the open interest is about 2,000, volume 2,000, open interest also at 2,000 and 2,000 for both of these strikes. We believe this is closing out the trade to take profits. Okay, they were closing out this, okay, and rolling to the March 15s. And they originally got into this trade on February 8. You can see here when AstraZeneca was trading at $63.52, it had dropped 4%. March 1st, you can see here the 63 strike calls, open interest of just 0. 66 strike calls, open interest of just 337. So these 2,000 contracts for both of these strikes, this was the day when they entered their trade and they got into the trade, where they were buying the 63 strike calls and selling the 66 in a vertical call spread. Okay, and you can see here that they were paying about 149 for the 63 strike calls and selling the 66 strike calls for 23. So the trade that they entered on February 9, 149 subtracted by 23 cost them about $126. Okay, so $126 was the initial cost of their trade. Now you can see on February 8 what happened. This is February 8. After earnings was reported, it dropped. And you can see that it's higher today from where it is. So clearly they made a profit, right? How much did they make? Well, we know that it was 126 was the initial cost. We know that the price of what they are selling them today, you can see here, the 66 strike calls, 43. The 63 strike calls, they're about 234. So what are they? What's their profit? So 234 subtracted by 43. So 191 is what they're selling for originally. They got them for 126, right? So it's a profit of about $65, right? Which is if we divide it by their initial cost of 126, they made about 51% profit. Okay. So what they're doing now is they've rolled up the dates to the new a new date of March 15, and they enter new strikes, 66 strike calls and the 70 strike calls. And we can see that these are opening trades, because when we take a look at the chain, you can see that at the March 15th, the 66 strike calls, volume 5,000, that's greater than 0, so these are opening. And the 70 strike calls, 5,000, it's also greater than 598, so these are also opening, right? And that is why we are also in this position as well. We're simply following this trade because the value of the trade is not as significant. You can see that what they paid here, this is their trade here, where they paid 84 and they sold for 11. So each trade was $73 times 4,675. So they spent $341,000. So this trade does not exceed $1 million. So typically we put a lot more capital and develop our own option strategies whenever trades exceed $1 million, as well as other variables that help us determine how high is this probability of profit. Okay, so this trade is not as high in comparison to the trades that we share on our website. And that's why we simply just follow the trades. If you are interested in the trades that we share on our website, make sure to go to our website. We'll put a link at the top here, where you can learn more on how you can gain access to the trades that have high probability of profit based on our analysis work, such as this. Okay, so what this trader is doing is buying the 66 strike calls now and selling the 70 strike calls. And when you analyze this trade, you can see that this is their new position. This is a vertical call spread. Okay. And as we had calculated, they were paying about $74 for each trade. Okay, so this is their trade. They have a positive delta, so they are bullish and going long. And you can see they're risking $74, and they can potentially make max profit is $324. So you can see that their risk to reward ratio, 324 divided by 74, is 4.37. Essentially, they could make 437% profit on this trade. And so can we, because we are following their trade. Okay, so let us know what you think about this trade. Do you think it'll continue to go up or not? And make sure to go to our website if you want to learn more on how we find trades that the wealthy traders are in, and also the ones that are making money as well. That's also very key. Okay, so we'll put a link at the top here on our website, and subscribe if you haven't. Hit the bell icon if you want to be notified of future unusual options activity with this type of data, so you don't miss out on these potentially profitable opportunities. Take care and have a great day.